Strip away the rituals, the folklore, and the violence. When the cinematic mythology disappears, what remains is a masterclass in extreme treasury management. The operators in this economy face a harsh set of baseline environmental constraints. They cannot rely on legally enforceable contracts. They have no access to courts to resolve disputes, and they operate under the constant, existential threat of immediate asset seizure by law enforcement. These limits force an inversion of standard business logic. In a lawful enterprise, executives optimize for yield, margins, and leverage. Yield, the return generated on an investment, and leverage, the use of borrowed capital to multiply potential gains, rely on predictable time horizons and stable counterparties. In an illegal market, those metrics are lethal. When standard optimization creates existential exposure, an organization must build a completely different set of financial physics. They engineer systems based entirely on deliberate inefficiency, compartmentalisation, and resilience. In a zero-trust environment, cash operates as physical authority. It leaves no digital trace, requires no intermediary, and obeys no banking compliance framework. For these organizations, cash velocity dictates survival. Inventory locks up capital in vulnerable, seizable forms. Receivables, money owed by clients for goods or services already delivered, create dangerous dependencies that invite betrayal. Therefore, moving cash quickly matters far more than extracting the maximum profit margin from a single transaction. Look closely at the money in motion and payroll first sections of this diagram. Rapid circulation enforces obedience and prevents defection. Lawful corporations facing crisis apply this exact logic, where idle capital transforms into vital operational insurance. A criminal syndicate's obsession with liquidity reveals a calculated architectural defense. Keeping capital highly mobile and fragmented prevents a single frozen bank account from triggering systemic organizational paralysis. Modern business assumes that sprawling, complex enterprises require exhaustive data retention and detailed enterprise resource planning systems to function. The Mafia discards this assumption. When courts offer no protection, exhaustive written records transform from essential management tools into catastrophic liabilities. A meticulously kept ledger is simply an indictment waiting to be discovered. Focusing on the spoken summaries and round numbers sections of this schematic, exact data is intentionally stripped away. As information flows upward through the hierarchy, it is abstracted. Granular details stay at the execution layer, and leaders receive only net figures. The system relies on repetition, human memory, and brief oral reports. Approximation obscures the scale of operations from outsiders while still allowing leaders to track directional cash flow. This mirrors the design of lawful executive dashboards. Senior management fails when submerged in transaction-level noise. They require trend awareness and immediate alerts for deviations, not a forensic view of every receipt. By removing the paper trail, the syndicate executes a precise risk transfer. They shift the systemic danger of legal discoverability directly onto human reliability and memory. Relying entirely on memory creates a logistical gap. Leadership still has to allocate capital and coordinate distant operations, and maintain command from inside a detention facility without ever holding a meeting or sending an email. This document outlines the strict parameters of the pizzino. Looking at the minimal content and reporting by numbers sections, notice the complete lack of explanatory context. Names disappear. Figures are reduced to codified sequences. The instruction provides direction without rationale. These notes facilitate decentralized reporting. A leadership directive is mathematically fragmented across multiple couriers. Because no single messenger holds the complete message, capturing one courier yields only useless, partial knowledge. Look at the sequential conversion and segmented movement sections of this chart. Converting cash into property and then shares requires isolated sequential commands. One note triggers movement, a completely separate note confirms receipt. Intercepting one link does not destroy the chain. Lawful firms employ a similar logic through modern secure workflow design. Utilizing zero-trust access controls, tiered authorizations, and need-to-know compartmentalisation ensures that a single compromised employee cannot expose the entire corporate strategy. The pizzino is the only exception to the rule of silence. Writing is deployed strictly when the risk of systemic collapse from distance or detention mathematically outweighs the risk of generating physical evidence. Generating illicit cash is only the first phase. Once surplus capital accumulates, the syndicate must store it without triggering regulatory audit alarms. Focusing on the false invoicing and cash-intensive sectors blocks, baseline accounting is engineered to confuse outsiders. High-volume, cash-heavy fronts like construction or logistics allow operators to artificially inflate or deflate revenues, seamlessly blending illicit funds with legitimate daily receipts. Within these front businesses, actual profitability is irrelevant. Operating losses and severe financial inefficiencies are entirely acceptable expenses, provided the operational cover holds up against inspection. Reviewing the asset lockbox and fragmented ownership sections, property acts as a capital storage mechanism rather than a yield-generating investment. The physical asset anchors the wealth, but legal control is intentionally fractured across shell entities to prevent mass confiscation. The enterprise balances its holdings between two distinct categories. Speed assets, the fast, illicit cash flows, fund rapid operational reactions. Endurance assets, real estate and gray market businesses, provide stability and permanence. External financial statements, audited or not, serve only as legitimacy theater for regulators. True internal control ignores the balance sheet entirely, relying purely on an unwritten, real-time awareness of cash flow. Corporate portfolio theory usually aims to capture market upside through diversification. In extreme risk environments, diversification is strictly a defensive tool designed to contain and isolate catastrophic loss. By examining the top three tiers of this graphic, illegal, legal, and gray assets, we see the necessary heterogeneity of the network. A single localized police crackdown cannot collapse the enterprise if operations span multiple varying sectors. That spread must also be geographic. By moving capital across borders, the organization exploits the legal friction, bureaucratic delays, and communication failures between different jurisdictional authorities. Managing this portfolio requires absolute emotional detachment from leadership. Assets are viewed as purely functional. If a sector draws too much heat, it is instantly severed and disposed of. Sentimentality delays divestment, and delay results in arrest. In the architecture of illicit finance, calculating standard return on investment is a distraction. For an organization hunted by the state, longevity and survival are the ultimate and only acceptable returns. The true test of this financial model occurs during catastrophic disruption, a sudden wave of arrests, sweeping asset freezes, and coordinated law enforcement raids. The network reacts automatically. Compromised nodes are instantly abandoned. Cash flows, communication lines, and authority structures immediately reroute around the damage, utilizing pre-established parallel paths. This chart demonstrates how that firewall functions in practice. Look at the redundant routes and sacrificial asset sections. Duplication of effort and planned acceptable losses are core defensive features. By intentionally absorbing local shocks and sacrificing expendable assets, the global structure protects its core. True enterprise resilience does not come from building impenetrable centralized fortresses. It comes from extreme asset dispersion and meticulously planned redundancy. To a traditional corporate auditor, this financial system appears chaotic. It looks grossly inefficient, wildly imprecise, and completely unscalable. Yet under extreme existential pressure, standard corporate optimization creates systemic fragility. When every dollar is tracked and tied to a centralized system, a single breach compromises the whole. Deliberate inefficiency spread across a fractured network buys the organization time. Lawful corporate crisis management eventually collides with this exact reality. When legal structures weaken, markets freeze, or records become liabilities, organizational survival strips away theory. Companies survive on protocol, highly managed liquidity, and structured trust. The financial architecture of organized crime proves a definitive rule of governance. Absolute control of a multinational enterprise does not require a written ledger. It only requires extreme discipline, enforced silence, and the continuous, unbroken flow of cash.